Over the past few months, the oil market has been closely watching one central question. What happens to the Strait of Hormuz, and what does that mean for oil prices? That remains, for good reason, the market's main reference point. But what I want to bring into the conversation here is a second factor that has become increasingly important, and that deserves to be discussed alongside Hormuz, which is the refining capacity worldwide. Because even if crude oil flows start to recover, the supply of diesel, gasoline, and jet fuel may remain tighter for longer while a relevant share of global refineries stays offline. These two issues move together, but the refining side has received much less attention. The best way to read this dynamics is through the crack spread. Since the conflict in the Middle East began, oil prices have been highly volatile, moving up and down as the diplomatic situation evolved and as the market reassessed future supply availability. Oil products, however, have followed a different path, with a more constant upward trend. The 3-to-1 crack spread, which represents the processing of 3 barrels of crude oil into 2 barrels of gasoline and 1 barrel of diesel, reached the highest level since the beginning of the historical series, getting close to $6-7 per barrel by the end of July and trading around $56 in early August. That is more than double the levels seen 1 year ago. Three factors help explain this move: fuel supply disruptions in Russia and the Middle East, stress in the US diesel balance, and lower refinery utilization rates in Asia. Behind these elevated spreads, there is a very objective number. Since the beginning of the conflict, offline refining capacity has increased significantly, reaching around 14% of the global total between April and May. But that absolute number is not the most important point here. What really stands out, compared with previous years, is the composition of that number. A large share of this offline capacity has come from unplanned outages, which represented 50% of total offline capacity in June, with Russia playing an important role through this period. And the distinction matters. Planned maintenance has a start date and usually a return date. The market price that with some level of confidence. Unplanned maintenance is different. It can come from an attack, a fire, or a power outage. There is no clear calendar and no clear repair timeline. Over the past few months, the indicator has declined, but we are still around 10% of total refining capacity offline, above the 5-year average for this time of the year. So yes, the situation has improved, but it hasn't normalized. When you look country by country, the picture becomes clearer. China is at the top with about 3 million barrels per day offline, but a large part of that reflect planned maintenance within the expected seasonal calendar. Russia is the case that stands out the most. It has the largest volume of unplanned offline refining capacity at around 2.5 million barrels per day, with Ukrainian attacks on refining centers severely affecting crude processing. At the same time, it is worth noting that unplanned outages stood at around 3.6 million barrels per day by the end of July, and some refineries resumed operations in early August. In Venezuela, the Paraguaná refinery, the country's largest refining complex, has been facing power outages and operational issues, with more than 1 million barrels per day offline. And finally, in the Middle East, Saudi Arabia and Kuwait have also recorded unplanned outages, with recent attacks by Iran and the Houthis in Yemen, reducing part of their processing capacity. Looking ahead, the maintenance calendar points to some relief. For August, expectations indicate a significant reduction in unplanned outages, mainly in Eastern Europe, as some Russian refining centers gradually resume operations. As a result, total offline capacity is expected to move from around 90% in the beginning of August to close to 5% by the end of the month and near 3% by the end of October. Still, the warning is important. There is uncertainty around the ability to repair these assets, and the risk of new attacks continues to raise questions about the effective return of operations. The Middle East also remains a region to watch, as new offensives and logistical constraints could reduce the exportable surplus. On the planned maintenance side, the reduction is only expected to begin by the end of October, mainly in Asia, which should continue to carry out repairs during a period of lower crude availability in the region, due to supply restrictions from the Persian Gulf. In this environment, the United States is capturing value. US refineries are taking advantage of very strong margins and increasing production, especially of diesel and jet fuel, to meet domestic demand and export relevant volumes abroad. Crack spreads in turn remain well supported, and investors are not only pricing the current picture, they are also pricing the expectation that the market will continue to operate with lower global inventories, especially for middle distillates. Russia's diesel export ban through August 2026 reinforces this view, and Moscow has already approved the possibility of extending that suspension into early 2027. And this is the point I consider most relevant. Even if there is a diplomatic resolution in the Persian Gulf, product spreads against crude oil should remain supported. The normalization period for the downstream chain is likely to be longer than for the upstream chain. A diplomatic solution can reopen a shipping route relatively quickly. A damaged refinery, however, needs repairs before it can return, and it also depends on the timely arrival of crude barrels to keep operating. To wrap up here, there are 3 key points to monitor. First, the possibility of new attacks against refineries in Eastern Europe and the Middle East, which could deepen the current situation. Second, the Atlantic hurricane season throughout the third quarter, which could affect part of US refining capacity. And third, the preparation for winter in the Northern Hemisphere in the fourth quarter, with heating-related diesel demand on the market's radar. Keep following StoneX channels to stay up to date on the main factors shaping your market. Thank you for watching StoneX TV, and I will see you next time.